Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Investor Podcast. I'm your host, Gary Lipsky with Break of Day Capital. If you've been listening to this show for a while, you know we focus on going a mile deep instead of a mile wide. That's exactly why we're buying again in Tucson, our 12th deal in the market. Our latest acquisition, Icon on Broadway, is a 300-unit multifamily community purchased well below replacement costs with day one cash flow and conservative underwriting. We're projecting a 16 to 18% IRR with significant bonus depreciation in year one. If you're an accredited investor and want to learn more, you can access the deal room at breakofdaycapital.com.
Financial advisor Bromley Palamountain of Northwestern Mutual empowers people to make their financial dreams a reality through purpose, clarity, and design. Be sure to check out his links in the show notes.
Today's guest is a good friend and collaborator, Dr. Tim Fergestad. Tim is a neuroscientist turned real estate investor and the founder and managing partner of Oak Street Assets, where he helps accredited investors grow beyond Wall Street through private real estate. He brings the analytical discipline of a scientist to evaluating markets, sponsors, risk, and investment structure. He also hosts the Phoenix Prosperity Podcast, and his core message is straightforward. Build wealth through ownership so you can own more of your time. Welcome to the show, Tim. Can you start by telling the listeners a little bit more about yourself and what you do?
For sure. Thank you, Gary. Good stuff. Yes. I transitioned from neuroscience into investing full time years ago because of what you just said. And it's becoming more apparent in this day and age too. I mean, AI is affecting some white collar stuff. And when the robots come, it'll affect blue collar jobs and stuff. And it's going to be about capital ownership, frankly. I'm a big fan of that's kind of one of my main talking points lately is the aspect of, well, I call it the income trap, but most wealthy people lose their income stream and they're in trouble. Whereas you start buying assets with the income stream, and that's kind of a big part of what I like to talk about now. But I learned that myself transitioning from real estate. I semi-retired years ago, and I didn't appreciate that myself. Right? I had traditional investments. I realized I had to educate myself on those and realized they were pretty crappy. And so I had to branch out, and I fell in love with real estate. Started doing a lot of real estate investing. And yeah, I just did more different kinds and scaled and grew. And as I grew, I started to realize, wow, these apartment syndications are where it's at, right? Because the power of scale. And I was a passive investor in other people's deals. I still am. And I love doing that. It's been life-changing, really, frankly. That's why I focus on it. And now I partner on deals and do my own deals and educate and share those deals with other people in my network.
Excellent. Was there like a turning point, a book you read, a seminar you went to, or it just kind of slowly built over time, realizing that was the way to go?
Yeah, I'm a slow learner, apparently, when it comes to investing. And so real estate was, I fixed and flipped, and I wholesaled some stuff, and I did land, and I had my own single family rentals, and I'm here in Phoenix, and I got a license. I was going to flip and hold my own plexes is what I wanted to do originally. And just things didn't pencil as well as they do in other markets. Yeah. Your investors probably are familiar with the 1% rule. Used to be the 2% rule, by the way. And it, you can't, it's a 0.5% rule here in Phoenix. And what I'm referring to, in case people don't know, is 1% of the purchase price is usually kind of a back of the napkin rule of thumb for determining what the monthly rent should be. So you buy a $100,000 house, you should be getting a 1% monthly rent. And I can do that in other markets. So I bought single families in Charlotte and Indianapolis and other stuff. And I learned what it's like to remotely manage properties and stuff. Even though it was passive, it wasn't really passive until I started investing in syndications, which was really passive. So you get a K1, right? And you have to hand that over to your CPA. Obviously, you got to vet the deal up front and so forth, and you have to put in your time and educate yourself on that. But for the most part, you're not operating, you're not dealing with tenants and any of that stuff. So people joke that real estate investing isn't really passive. It can be passive. So it slowly happened. I had some friends with some deals, and I realized I invested in some of those and was like, wow, why am I bothering with single family rentals and trying to do this myself? I'm getting a better return when I don't have to do anything. So started doing that.
Yeah, I think that a lot of people make that mistake, because they get taught you've got to buy some real estate. And so a lot of people don't even know about real estate syndication. So they buy these single family homes all over the country. And if the one person isn't paying rent, you're not able to cover your mortgage or your expenses. And it's a real problem. And things are great until they're not, until that person's not paying rent. And it could be a real hassle with very little appreciation. You're not forcing appreciation, and you're going to get calls about toilets, trash, or whatever during the worst times when you're going on vacation, you're busy at work, whatever it is. And so it's a real, like you said, probably a lot more work and a lot less returns.
And the city finds the rental property for trash sitting out that you don't know about, and they send the letter to you instead of your property manager. And weeks go by, and you just the fines add up. All sorts of dumb stuff like that. Yeah, I'm a big fan of real estate. It's just there's some lessons along the way that make real estate awesome or okay.
Right. Well, I got to ask you. Okay, so as your experience as a neuroscientist, how has that helped you become a better real estate investor?
I need some like nerdy glasses to put on or something. I like a lot of people who are in analytical types, right? We do spreadsheets and math well and things, which is like step one, maybe. I think what's been good about being a scientist is the critical thinking, right? The curiosity, but also the skepticism. It's a good balance. And I think of an investment is a hypothesis, right, about the future. And there's so many variables, and you just keep testing things and tweaking things. And some variables are more impactful, like exit cap rate versus, rent growth or the creative aspects of it are some of being an entrepreneur is problem solving. And that really lets creative people be successful. You have to have an imagination. And a lot of people don't think about that when they think of scientists. They think some number cruncher nerd, but you get weird results. You have to interpret them. Some of the most successful scientists are the most creative. And I think even Einstein said imagination is more important than knowledge. And I think it applies to investing as well. We run into problems, right? Financing, you're like, well, there's something here. How do I make this work? Right. And that's actually some good tax advice, too. I've somebody who used to work for the IRS said the question is not how can I deduct this? It's how can I deduct this? Anyway,
I've heard that same advice, and it's proven very, very valuable.
Yes. Yep. Hope that answered your question. I think being a scientist makes for a good investor, actually.
Yep. You mentioned earlier the earned income trap. Do you want to expand on that a little bit more?
Oh, yeah. Well, it's as my wife is a physician, right? I'm a PhD. So if you fall on the floor, I'm not going to help you, but she probably could. But it's not just lifestyle creep, right? It's the fact that you part of it for that in that situation, a lot of high income earners who are physicians who had decades of training, right? They've had a lot of delayed gratification, and now they want to buy a house, and now they want to buy a car, and all of a sudden their expenses go up, and they're living off their income, and they're not buying assets, and they think their house or their car is an asset, and generally it's not, unless it's making you money consistently. So that's kind of the trading your time for money trap, and that's where assets is freedom. And a lot of people don't appreciate how true wealth is built. The difference between being rich and being wealthy, right? Is you don't have to show up and you can still have everything covered. That's wealthy. And that's kind of a big focus of mine. I've had, as I have kids leaving the nest now and stuff, it's imparting these values and principles that teach them to create value, add value, and put their money to work, I guess is the better term, maybe. So the earned income trap is just that, when you're trading your time for money. And when you do that, right, the dollars are your cap, right? Whereas private assets or passive assets buy back your time.
Yeah, it's a conversation I have a lot with my older daughter. She's 24 years old. She's been in the workforce for about a year and a half, and trying to figure out how will she eventually buy a home one day, or like maybe we talk about like a BRRRR where she can, buy a place. I can help her buy a place, and she can rent out other rooms and kind of learn and create some value that way, and kind of start her path on attaining assets and building wealth over the long haul.
Right. And this gets back to what I hinted at earlier in the podcast is the landscape is changing, right? I mean, it's harder to afford a home. The affordability gap's pretty legit in most markets right now. And you really have to be intentional about it. And I think asset owners are going to be the ones that continue to grow in wealth. There's so many people are just consumers and they can't afford to own the asset. They're subscribers, right? They get Netflix and everything else, so they're not actually owning anything. And capital ownership is where the future is. That's where the money's that's going to be the distinguisher in the future. I mean, if you have universal basic income, they'll pay you a little bit here and there. Where's all that money going to go? They're going to have to buy food. They're going to have to pay rent. That's all going to funnel to the people who own the assets.
When you're looking at a potential syndication investment, what are some of the top things that you're looking for?
Well, I'm looking for Gary Lipsky. I know, honestly, it's I'm looking for operators who have experience in their market, right? And I say this all the time. Most people, when I bring them a deal, or if they're new to investing, they always want to know, oh, what's the deal? What's the story? What's it like? Oh, it was an ice cream shop, and now it's now it's a co-working space with 3 rooms upstairs or something. No, I've seen great deals get destroyed by bad operators, and I've seen weird, strange, bad deals get saved by creative operators, good operators. And so it's just one of those you bet on the jockey, not the horse situations. And market forces are huge. They're very big, but generally speaking, good operators don't play in bad markets. So I top of the tier. So most people want to know about the deal. What are the returns? Where is it? And there's a team. Who's running it, right? It should be flipped, completely flipped. Who's running it? What's their track record? What do they do? Are they specialized? Some things like that. Then you get into where is it? And then finally, what's the actual project? And that's not intuitive for most people. I get it. It's just, in my experience, that's the order of importance.
100% agree. And I think a lot of people got burned investing in 21, 22 because of that was the case. Now, certainly even good operators and good deals have struggled, but
sure.
Investing with the right operator it gets you a lot farther than projected returns.
For sure. And I've updated some of my stuff. I have like a free scorecard, right? A syndication scorecard and a due diligence guide, right? Freebie for people on my website if they care. Or timfergestad.com is my link tree that has goodies like that. But it has the basic initial questions, right? That I've learned over the past cycle to be thinking about, because black swan market forces, some of that stuff was just crazy when they printed so much money into the market and it just changed values. There's some of that stuff you can't control for, but you got to be agile. You got to keep pivoting and so forth. That's why good operators, they're active in bad times, I guess, right? What's that book? Who did Good to Great?
Jim Collins?
Maybe. And there's a second book, Great by Choice.
Oh, yeah.
And that one talks about the 20-mile march. The analogy that they use in there is the race to the South Pole. And there were 2 teams, and one trained for all those terrible conditions and everything, and they marched 20 miles every day. Whereas the other one was like, oh, it's a storm, we'll hunker down. Oh, the weather's good, and, make hay when the sun shines, and we'll go double time on the good days and other stuff. Long story short, the one that trained for the hard times and went 20 miles every day made it there first, and the other one died, by the way. The other people died. But then it goes on to show all the parallels in business and how that works for all the business. Almost all the long-lasting, strong businesses operated through the tough times, and that's why they got really, really good. And that's, you're a very good operator because of all the challenges that have been put before you that have honed your skills.
Yeah, even deals that we've done really well, man. oftentimes they could be the hardest at times, but it's like you said, it's solving problems all the time, and just keep working through it. It might not be plan B, it might be plan C, plan D, plan E, plan F, but you gotta keep pushing. And it's just taking business skills that not everyone started in real estate, but taking it from maybe your past experiences and applying them to real estate, and those hard lessons.
Right. Yes, for sure.
Speaking of the last few years, I know there's certainly some investors that may be a little snake in, that have lost some money, or deals not going well, and obviously there's this really great opportunity ahead of them. What kind of advice do you give them, or how do you talk to them that might be
right?
They may be reluctant because of the times,
Sure. Well, it's a lot easier because I've been there, right? I've invested in other people's deals. I've had a deal go south and stuff. So it's hard, but I understand it. I feel it. I felt it more than most. So markets don't stay euphoric forever, right? There's cycles. They go up and down, and being able to ride those waves instead of be crushed by them is part of the skill. I'd say that real estate in general, mostly multifamily, lately, office took a really big hit with COVID and stuff in some markets, but there's always uncertainty, right? If you think about your retirement portfolio, right? If you're 20 years out and the market falls 30%, you don't hope prices recover before you buy more, right? It's like dollar cost averaging or something, right? When things are down in the stock market, unfortunately, people sell, but that's when it's on sale, right? So I think that this is a great opportunity to buy. We're arguably in most asset classes and in most submarkets, we're already past the bottom of the market. In some markets, we're still at the bottom of the market. Like Class A is past the bottom of the market in most places, but you don't hope prices recover before you buy more, I guess is what I'm saying, right? You don't want to wait till the prices go back up to full price and then buy.
Yep. So as a neuroscientist, what's happening in the brain? Because a lot of investors do buy, at the top of the market and sell at the market bottoms, like what's going on there?
Oh, yeah. Well, as we're emotional creatures, right? And our brains are built to survive, right? Immediate threats. And we have a negativity bias. So when things are good, right? We follow the herd, right? It's social proof. We get on board pretty easily. But also when everybody's feeling pain, we do not want to associate with bad things, right? It makes us feel bad. And so logically, we just talked about, we know that it bottomed out and now's the time to buy, but we have a bad emotion or feeling with it, right? So the fear, or the negativity, the emotions associated with where things are, how things got there, is hard to override, right? Our ancestors survived by following the herd, but investors often succeed by questioning that.
Yeah, I definitely I've seen that over the years of my investing in real estate and talking to investors that certainly during the peak it was FOMO and everyone's throwing money at deals.
Yeah. Bad deals.
And now is the time to be buying. And
now we have great deals and people are afraid. Like, these are some of the best deals I've ever seen. Some of the best risk-adjusted returns, like Icon and Pima, right? That pref rate. I'm just like, that's so solid.
Right. Can we actually train ourselves to make better decisions under uncertainty? Is there a way to do that?
Sure, of course. Our brains are like a muscle, right? That's how I usually think about them. They're adaptable. One thing is get the reps in, right? You get used to it. You toughen up, right? You stop being so emotional when you have good or bad things happen, right? That's step one, I think. And that takes time though. That's not a very helpful answer for people who don't have the reps in yet and haven't done a lot of investments. Otherwise, I think generally have a framework, right? Kind of like the scorecard I mentioned and stuff. If you have a system, you follow the system, so emotion doesn't get to bias or drive your behavior, right? good investors don't eliminate their emotions; they just mitigate them, right? They reduce the number of decisions that emotions get to make.
Well, Tim, I appreciate you coming on the show. You're probably my first neuroscientist I've ever had on the show. So
nice.
Thank you.
Excellent.
Tell the listeners again where they can go for the scorecard and your website again.
Oh, well, oakstreetassets.com. And I think /scorecard is the spot for that. But I also have timfergestad.com, which has some other resources and useful.
Great. Awesome. We'll put that in the show notes. Awesome. This is Gary Lipsky signing off. I'll be back next week with another informative episode on the Real Estate Investor Podcast. To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and like, subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.